Okay, now we move on to the actual audit report that Deloitte and Touche has provided to the shareholders and board of Berkshire Hathaway, and that's included as part of the 10K filing. So in any audit, there's always at least a few paragraphs. Nowadays, there's a couple pages of information that's provided at the very beginning. In this case, most public companies, I would think all public companies have audits. There are other types of financial statements, reviewed statements, compilations, and others. And there's uh, always disclosures as to any limitations or conflicts or things that might have arisen during the audit. So it's important to go through and read these pages. So don't expect to find anything of note in here, but we'll go through it, and we can see that in their opinion, it presents in all material respects the financial position and the results of Berkshire. That's not surprising. They do highlight this ASU 2016-01, which is the change in accounting that recognized investments, unrealized gains and losses through the income statement. They point that out. Of course, they always have this disclosure that their work is not perfect, and they rely on the internal management to a great degree to assess what they present here. They do point out, Berkshire's case for any insurer that estimates are critical because they're assuming losses that project far into the future, and any changes in those can have a huge effect on the financial statements. So, this 42 billion of retroactive required a high degree of auditor judgment. So, in many cases, the auditor's judgment often will follow management's, and you have this regulatory or accounting oversight capture, as it's called, where the auditor or regulator sort of falls back on management to too high a degree in a fraud situation. That happened with Enron, but Berkshire's financial statements, to a very significant degree, are more conservative than almost any other that are out there. They do point out the goodwill. This acquisition that they're talking about in 2016 was Precision Cast Parts, and they talk about how if the intangibles, if the goodwill was improperly assessed, that could cause a revaluation to occur, and then they sign off. And they do note here that they've served as the auditor since 1985, which is it's quite a long time. It's actually not uncommon to see auditors change over time. That might actually be a good question for Warren at one of these next meetings. So here we have Berkshire's consolidated balance sheet, and Buffett has actually said in the past that there's not too much to glean from this because, as we know, there are hundreds of businesses within Berkshire Hathaway, even under this other category. So to look at Berkshire Hathaway on a consolidated basis, there's little to glean. Really, the information and analytical value is within the notes themselves, which we've been going through. But we can see what Berkshire has for total cash and short-term investments, and in some other categories here, the equity and bond portfolio. Buffett, and it's important to point out when you're looking at the cash, the total cash that's reported does include the railroad and utilities, and this is probably an appropriate level of cash for those regulated entities to have. So when you look at how much excess cash Berkshire has, it's probably within these two categories substantially. This is probably needed in the business. You probably could not actually take it out, but it is a relatively minor piece. We do see the goodwill here. This is a net amount after any accumulated amortization. Same with the other intangibles. And here we see the deferred charge under retroactive reinsurance contracts. These are the assets booked that make up the difference between the premium received and the ultimate liabilities that they think they will pay out, which is booked as this asset and then amortized into expense over time. Continue down. These categories I've highlighted here, these are the major components of float. So they are within the liability section of the balance sheet, but they are, in fact, because they are so long in duration, money is paid out, but money also comes in from new contracts, and it sort of acts as this revolving fund that it actually functions very much like equity, which is not something to get into now. But so you have those liability amounts, and then the deferred charges, that's a negative, and then some other, as well as some receivables are negatives that go against that to get the net 129 billion of insurance float. So what's interesting here, we can actually get sort of a rough view of what the utility and railroad business balance sheet looks like. You can look at their specific 10K filings for both the railroad and the energy business, but just combined 187 of assets, and then we have 88 billion of liabilities, including payables. But subtract the two, there's about 100 billion of equity in those two businesses, and it far underweighs the intrinsic value of those businesses, but I won't get into that going through here. You can make your own judgment in terms of the earning power and assets that those businesses have. One important thing to note here, you can pull it out on a consolidated basis that actually has some value, is this income tax, deferred income taxes. So we can see here that deferred taxes went up during the year. So we'll get into that when we get into some of the notes in a few minutes. The treasury stock that Berkshire purchased during the year shows up on this line. And so here when we're looking at the consolidated balance sheet, and when you're talking about book value, the number that is reflective of the publicly traded shares is Berkshire Hathaway shareholders' equity. But when we're looking at the entire company, because everything's consolidated, it's a relatively minor amount, but this roughly 4 billion of non-controlling interests are all those other owners of the companies, primarily Berkshire Hathaway Energy, but there's a few other cases in which the other shareholders' interests are commingled with Berkshire's assets and liabilities and then netted out when we look at this line. Same sort of thing with the income statement. Very little analytical value at this level. We can see the revenues from insurance and other, railroad. So this 254 billion of revenues for Berkshire on a consolidated basis. And they do break out the investment and derivatives gains separately here. So that including that right there kind of throws off all of these numbers below because the earnings before tax and all of that do include those investment and derivatives gains. But just wanted to point out the income tax expense right here, which will become important later. This section, they report the average shares outstanding, which you can see went down because there were some repurchases, but I like to look at the actual number at year end, which is on the within the notes to come. The statement of comprehensive income, this is sort of like a bottom line. You can think about that. In years past, and this is actually a very good place to see this, the unrealized appreciation of investments used to flow through this statement. So Berkshire's earnings, well, they were affected in 2017 by the tax change, which threw things off. The net change in unrealized appreciation of investments used to flow through here. It's now flows through earnings rather. So this would have been included up here in prior years, and so that's or in future years. So that's already included in this number. There's already there's a few minor things happening with investments here, but the bulk of it is already in earnings, and also we have the change in the pension plan is reported here net of tax. You can see those broken out. So that sort of reconciles the change in Berkshire's equity with its income and other things that are happening. And we can also see that the consolidated statement of changes in shareholders' equity here, this goes back to 2016 and flows through to year-end 2019. But you can start with the total here, 352 at year-end 2018, and we can see how it went from 352,500 up to the 428,500. And the big component was that net earnings, which again in prior years would have included the gains in other comprehensive income, but in this case it's included in earnings. But that flows through. So a big plus is the earnings. The big minus is the repurchase of shares, and then the sort of couple minor things here with the other OCI as well as non-controlling interests to get to the net figure. The statement of cash flows, just a couple things to point out here. There's a lot going on, but what I typically look at is the depreciation expense, 10 billion, and the purchases of plant, property, and equipment. We already kind of know that. We saw that elsewhere, that Berkshire outspent its depreciation. So it spent 16 billion. It depreciated by 10 for a net gain of 6 billion. The income taxes, I just highlighted that because there are the income tax expense, as we saw above, was 20 billion, but because some 2/3 of that was deferred, that actually gets added back in the statement of cash flows to bring us to net cash flows from operating activities, 40 billion, which is quite significant. Berkshire's throwing off quite a bit of cash. The other thing to note here in this next section in investing activities is the net change in equity securities. So, and it's a negative because cash went out the door. So Berkshire spent 18.6 billion on stocks, but they also sold 14 billion. So you have a net of roughly 4 billion of purchases. And some of these other asset categories like the treasury bills and finance receivables, it's worth looking at, but they're less important in my mind than some of these big activities. When any businesses are acquired, they show up on this line. And here we see the change, the repurchase of shares over the last 2 years. And this section here reconciles cash and equivalents. It does not include treasury bills, so just something to point out. So we'll continue down the. So those were the main financial statements, And what starts here are technically the notes to the financial statements. And it goes through a lot of information. Much of it, or good amount of it, is repeat from elsewhere in the report, but it is worth reading in its entirety, at least at least once. In a company like Berkshire, you want to see what changes, but you get sort of a sense for how they report these things over time. So once you've read it a few times, you can kind of skim through, looking for some of the more important things. But when you are reading this, it's worth. I think you do get a, if you're not an accounting major or even a business major, you can usually pick up. Accounting is a language, but you can usually pick up a good amount of how things are accounted here. It's just a matter of time, applying yourself and kind of tying some of the numbers together that you see through the report. It's kind of fun to do. And if you are that accounting or business major, it's very helpful to actually go through and tie out these numbers in certain places. And you'll see some of that as we go through this. But you'll get a sense for why certain things are done in certain ways and how they're accounted for by going through these notes. And in other companies, you get a feel for. There might be some important information in these footnotes. So never just totally discount them and skim them over. There may be certain ways that they account for things that are buried in these notes, that there might be some strange way that they value something or account for something. And it's worth taking the time to understand how they're accounted. So kind of skim through here. One big thing, not really big for Berkshire, but one thing to note is this LIFO method. So FIFO, LIFO, last in, first out. The difference between, I guess they're calling it non-LIFO now, and LIFO can be a significant delta. You can have a significant amount of asset that's basically off the books. It could be a plus or a minus, depending on how certain things are accounted for, which could be important to understanding the financial statements. In this case, it's really not. But here's one thing, again, for other companies, for all companies, it's probably a good idea to understand if they're users of fixed assets, what sort of life they expect out of them. And, with Berkshire, they have businesses that range from, very capital light to very capital intensive, like the railroad. And, we can see here, there's some of these assets stretch up to 100 years. And it's important for a couple of reasons. One is you want to understand whether they are appropriately, or if something seems kind of off on the useful life of something. Could be an indication that there's some games being played. So, if you have just to use an example, a computer maybe, I think might have an economic life of 3 years. If they were depreciating a computer over 10 years or 15 years, you would kind of know that, well, hey, what kind of effects does this have? Well, it's underestimating depreciation because that cost is amortized over the life of the asset. So that would, all things being considered, have an effect of artificially increasing income. But for Berkshire's case, and Buffett even points this out, these assets that are on the books for so long, actually, because of inflation, it tends to understate the amount of replacement capital that is needed for the railroad. So something just to be aware of. Again, it ranges from 5 years, 50 years, 3 years, depending on the type of asset in question. Leases, and again, we'll get to some of the numbers in a minute, but there was a change in lease accounting over the past year that really had no economic effect, but put assets and liabilities on the balance sheet that weren't reported before. Instead of an expense, things were capitalized and then depreciated. So you learn these things through the footnotes, and that will help you when you actually get to some of the numbers. Same with revenue recognition. It's important. Berkshire just has so much going on that it's really, as a whole, probably not material, but any other company, it's important to note how they recognize revenue. If it's a candy company selling a piece of candy like C's, that's pretty quick, but you might have an aircraft like Precision Cast Parts where it has contracts stretching over years, and how those revenues are recognized into income can have a pretty big effect on the financial statements. We'll skip over this stuff here, losses and adjustment expenses. It does go through some of the things we talked about in terms of how these are put together, how they're estimated, what they're comprised of. Same thing with the retroactive. Insurance policy acquisition costs. I don't think we touched on this before. There are certain costs, Geico's advertising being one of the biggest ones, where if you spend money to acquire a customer, that becomes an asset that should be amortized over the life of that acquisition. So, direct incremental acquisition costs here, commissions, premium, taxes, other costs associated with successful efforts. They do differentiate that. I think it was 2012. They had a change in, I call it DPAC, deferred policy acquisition costs, that negatively impacted the financial statements and was important to understand. But these unamortized balances, so it's money that goes out, it becomes an asset, and then it's amortized into expense. That asset was about $3 billion at year end. Again, we'll skip over some of these things. Here is this. They usually put in any new accounting that's either been put into effect or that's coming down the road. And in 2019, January 1st, this ASC 842 was adopted, which they usually have a time frame for which they have to adopt these things. But basically what this amounts to is there was all these assets that were leased, and instead of having a lease expense, they're now considered right of use assets. So you have the right to use these assets, and that's in Berkshire's case worth $6.2 billion. And then you also have this obligation to pay the lease, which is worth $5.9 billion. So that had the net effect of reducing other assets by $300 million. So that affected Berkshire's equity. Actually, this did not, because it's 6.2, 5.9, and 300 million. So that adds up to 6.2. So it's actually it was a wash from that standpoint, but it did have the effect of impacting the balance sheet, and that tells you right there what and where to find what that change was. This 2016-01, this was the change to deferred or the tax liabilities with associated with the investments. So effectively, there was no change. All it did was move the unrealized gains from accumulated other comprehensive income into retained earnings. So that's just a wash from that perspective. There was this $76 million from this other ASC 606 that had a net effect on Berkshire's balance sheet, but really very minor in the grand scheme of things. And it's kind of neat to see, this accounting rule was proposed in 2016, hence its labeling here, and it took a few years to be put into effect. And that's usually the case with some of these. There's lots of lobbying that goes on. And this is one that's coming down the pike, and they do notice what might happen. This primarily applies to banks, but it does apply to Berkshire because of those large amounts of mortgages and receivables that are on the books. So this is the accounting for credit losses. Effectively, it makes the accounting for mortgages and bank assets similar to the insurance when they reserve over the life of the asset. It was proposed in June of 2016, and it will be put into effect beginning after the end of this year. So they don't expect it to have a material effect, but this is that same rule that applied to banks, unless I'm mistaken. A couple other things here. Goodwill test, another one here. Most of these they don't think will have an effect on the Berkshire's financial statements. And we move into business acquisitions, and Berkshire does note here what their long-standing acquisition strategy is, and so any significant acquisitions are detailed in this section. So the biggest one was Medical Liability Mutual Insurance Company, October 1st, 2018. Berkshire paid $2.5 billion, which was I don't think it's listed here, but it was $100 million over the equity, shareholders' equity, as of that date, which went to policyholders. And they tell us that it had $6.1 billion of assets, including cash, and then the investments of $5.2 billion, and then its liabilities were $3.6 billion, most of which were the $3.2 billion of unpaid losses. So Berkshire paid a pretty good price for this. It seems they did get a good amount of assets, a good amount of float for that, which they basically bought it at book value. So pretty good acquisition. All of the smaller acquisitions that happen over the course of the year, sometimes Buffett points out how many there were, but they do aggregate them into one figure. And in 2019, that was a little under $2 billion. So if there were larger acquisitions like Precision Cast Parts, when that happened, Duracell, they often will list the actual assets, broad categories of assets and liabilities that were acquired, which can be quite interesting. We saw this figure previously in the 10K. This is just reported again. Berkshire's bond portfolio, a little under $19 billion. Its equity portfolio, again, same figure, $250 billion, 67% in the top five, which is just awesome. The $10 billion Occidental Petroleum deal is summarized in this part right here. We're told that it is included in the commercial, industrial, and other category up here. So it's included within the equity security portfolio. So pretty good deal for Berkshire. $10 billion went out the door. They get warrants to purchase 80 million of shares at $62.50, 8% coupon, a 10-year deal. They can redeem it at a 5% premium. And this has actually been put into effect. Dividends on the preferred may be paid in cash or shares. And there's a trailing, I forget the specifics, but a trailing formula on which that is based. And Occidental, with the rest of the oil industry, has been thrown into disarray, and they have elected to pay in shares. So if Occidental has done well, Berkshire will get its 8% dividend, preferred dividend. If it's not doing well, it will actually accrue shares in Occidental at a pretty steep rate. So if the company does not go bust, Berkshire will have quite a sizable interest in Occidental, but it's too early to tell how that will play out. Equity method investments. So we talked about those before. Kraft, Heinz, also Pilot Flying J, Berkadia, and Electric Transmission of Texas is included in that. Skip over some of this. With Berkadia, it's with, I guess it's Jefferies now, but they own 50%, and Berkshire guarantees it, but Jefferies indemnifies, effectively guarantees the other half of losses under any of the borrowings through that. Talks about the fact that Berkshire will own 80% of Pilot Flying J in 2023, with the Haslam family retaining the 20% remainder. Here we see the investment gains and losses. So, the 71 billion, you can see what that was made up of, the unrealized and then the realized components. So both equities and fixed maturity or bonds. Loans and finance receivables, the bulk of these are within Clayton. So, just like a bank, they talk about how the assets are performing, who's paying, and the portfolio has historically performed very well. So 98% of manufactured housing loans were evaluated, and of those, 99% were performing, and 96% were current. So, which is pretty amazing considering that Clayton's average borrower is, at least on paper, not the best credit risk, but Berkshire and Clayton does a great job of making sure that people are appropriately have the right balance between their income and what they can afford for their house. Berkshire has a $2 billion loan to Seritage Growth Properties that was spun out of Sears a few years back. Buffett actually owned some equity in that. I don't think he has it anymore, but tells us what the outstanding balance is. Receivables. And again, these numbers, essentially what we're doing here is we're picking out one number and just going deeper into what it has within that category. So if you looked on the balance sheet, you'd see these numbers, at least the total listed, and then we can see what they're comprised of. So the insurance companies have some receivables, they have some reinsurance that they're waiting for, and then some of the just in the course of business, there's going to be trade receivables for the many manufacturing, service and retailing businesses. And of course, there's always an allowance that's deducted for uncollectible accounts. They do break them out between insurance and other, which is essentially the MSR businesses plus the insurance, and then the railroad and utilities are listed separately. Inventory, you can see how that's broken out into the various components of inventory. And then we move into the property, plant, and equipment category. So this is broken out into three broad categories here. So this first grouping is insurance and other. So 42 billion gross. After depreciation, it's on the books for 21 billion. And you can contrast that to the railroad, which has 64 billion of net fixed assets, and the utilities and energy business, even more capital intensive, 73 billion. So just those two businesses, the railroad and the utilities, are a net of 137 billion, which just speaks to their it's as we would have expected. So, as you're going through this and you're sort of thinking about the businesses that you're looking at, these things should sort of not surprise you. And if they do, you dig through and you try to understand it. And if you can't understand it, you try to get educated on it. If you can't, it may be something that you want to pass on. But this is all very straightforward and what we would expect to find. The equipment held for lease, this is all pretty straightforward. Berkshire's UTLX and Procore rail cars listed here. Aircraft, it's primarily net jets, should be all net jets. Other, and then of course their net of depreciation, and they are depreciated. And we can see the operating lease revenues and what their future expected lease revenues will be. Those are detailed here. Some more detail on the leases. Berkshire's goodwill and intangibles. We can see, when they have a beginning balance, they acquire businesses, add to that, and then there's sometimes some deductions from that. About 82 billion goodwill on the books. Now the intangibles are kind of important to understand. So earlier we had talked about Buffett determining that about 20% of the amortization expense was real. And you can see, so on the books are quite a large amount of assets under intangibles for these customer relationships. So when a business is acquired, the way they do it is they put an asset on the books called customer relationships, determined in various ways, but it's actually amortized. So you can see the accumulated amortization has increased, which means that net has gone down. So Buffett would not think of customer relationships as something that is a declining asset over time. So that's something that he would have added back. And these have all they don't have necessarily the same schedules. They might have varying, sometimes they're listed, but in this case it's not. The varying amortization schedules, the life of these assets or supposed life. Trademarks, another one, probably stick around for a while. Technology, that probably amortizes. I mean, that's a real expense. So just understanding what the assets are and not blindly either accepting it as fact or making a blind judgment saying, well, I'm going to add back all of it. It's really important to understand what the assets are and what you're looking at. And it's really sort of proves the point that accounting, it's just the first step, and you really need to understand what it's saying, but then you need to take the next step and think what might you need to adjust for, or what does the accounting world requirements say that might be different from economic reality, because they can only go so specific. There's some things that just they just have to sort of categorize, and you need to think for yourself. Essentially, you can make your judgment on some of these things. So indefinitely lived assets, intangibles were 19 billion. So those aren't included in this table. These are just the ones with definite lives. Here's the derivative contracts. These are the equity index put contracts. So again, 2000 written prior to 2008 on four indexes, and they received So the contracts that are remaining have Berkshire received 2.5 billion for, and they won't expire for a few more years, and unless they expire at or below a certain level, Berkshire won't have to pay anything, but odds are they make a good amount of money over time. This is a table worth understanding unpaid losses and loss adjustment expenses. So this details the balance sheet flows essentially of the insurance losses. So on the books, if you looked at the balance sheet, you would see these gross liabilities. Well, you would see this at the end of 2008. So that's the same number as down here, flows up to 2019. This would be a liability on the 2018 balance sheet. This would be listed as an asset. So the net liability is the 65 billion. So that's where they started the year. Through the insurance operations, the current accident year events, there were 43 billion in losses, incurred losses, not paid. And then the loss development is listed under prior accident year events. So this negative, these three negatives, are a good thing. That means Berkshire is conservatively reserving under collectively all of its insurance contracts when the liabilities are looked at going forward. Most often they're found to be conservative, which it's good for. It protects Berkshire Hathaway shareholders. It protects the insured, and it also leads to Berkshire paying less in income tax. So if you're conservative, or if you're overly optimistic and you're reporting all this income, you're going to pay money on it in taxes. And what really counts is how much you pay out over time. So the fact that they're a little bit conservative is a very good thing. So that's the incurred losses. Now the actual payments that went out the door are in this next section. So just taking the current year, 43 billion is how much Berkshire incurred. They now have this liability to pay this amount, but then for the current year, they paid out a little under 20 billion. So that net between the two is actually added to float, and then payments under prior year losses. So they determined that the losses would ultimately cost them less, but that doesn't mean that there weren't payments from prior year's events. So all those payments that went out the door for losses incurred in prior years was this 17.6 billion. So a net between these two, the 42.5 minus the 37, with some adjustments here for the acquisition and disposition. I believe this was applied underwriters, and this one was what was 2019? Anyways, these this acquisition here, this would have been medical liability mutual, and the 670 probably would have been applied underwriters. That has an effect on the net losses, net incurred losses. So the net liability, if you looked on the 2019 balance sheet, you would see the 73,019, but Berkshire's net of reinsurance recoverable is the 70 billion. And so they break out the prior accident years. Current accident year included approximately 1 billion for catastrophe events, and then this 752 million of favorable loss development is split between the primary insurers, so Geico and the other primary insurers, 457, and then the property and casualty reinsurance net were 295 million. So we'll move into this next section here. There's a lot of numbers. It might take you a little while to sort of walk through and understand what you're seeing here. But and you kind of think through the businesses, and you look on the balance sheet, and you can see kind of how these numbers flow through. So here was that 73,019 in gross liabilities. We see that again right here. So it's another way of looking at the unpaid losses. So this is broken down not only between some of these categories, but Geico physical damage, the auto liability, the medical, workers' comp, Berkshire Hathaway reinsurance, property, and then casualty business. So this ALAE is allocated loss adjustment expenses. Just think of it as an additional category of losses. Insurance recoverable. There's that 2785 plus. Okay, that doesn't net out. Some of these figures, there's some more going on within them, but the major categories tie out here. We'll look into that right now, but basically, this is how those unpaid losses are distributed across the universe of Berkshire's insurers. And when we dig in, we can see some of the specifics. So remember, Geico is auto insurer, short line insurance. Premiums come in, they get paid out fairly quickly. So we're really looking at only a few years. So physical damage, that is pretty quickly determinable. And that's why there's only 2 years listed here. So what this is saying for physical damage, this is the detail that goes into this favorable or unfavorable loss development. So what this is telling us here is for the accident year 2018, Berkshire originally thought that that would cost $8,345,000,000. When they reevaluated those liabilities at the end of 2019, they determined that they were actually lower. So that net between these two goes into favorable loss development, and it goes into underwriting as a lower, as a negative underwriting expense effectively, and lowers or otherwise increases underwriting profitability. These incurred but were not reported in case development liabilities. These are sort of those other remaining. We talked about those before. Those are what Geico estimates are left to be paid that they don't have a specific handle on. Of course, being a year removed, they do have a better idea, and so those are lower. And 2019, they're higher because they just don't know. And so that's across almost 9 million claims. And so those are the incurred losses, the cumulative paid losses. So again, using the account year. So 2018, they thought they lost 8.3 billion, and they quickly paid out almost 8.1. So you quickly know when someone gets into an accident, what that will cost. So that is that showed up because they're paid pretty quickly. That also sort of flows into why the incurred losses are pretty quickly known. So the net unpaid losses, which you would expect to be pretty minor after a couple of years, those are pretty quickly determined. Now, when it comes to auto liability, this table goes over 5 years, which makes sense. Again, it's short tail, but it does go out over some time. In the auto liability, that might be for bodily injury, personal injury. So those can stretch out over a couple of years. So again, we just kind of look at this from a broad perspective. You can go through each year and see just the accidents that happened in 2015. how they changed over time. So 2015, this 10,590. Then this would have been unfavorable loss development because it went up again, went up again, and went up again. So, but you can compare the two basically over the past 5 years. 2015, they did not do a good job reserving underwriting those losses. And of course, because time has gone by, these IBNR and case development liabilities are fairly low. Taking the next year, accident year 2016, went from 11,800 to 12,178. So again, unfavorable loss development. 2017, 14,095 to 13,888. So you will see a year or two sometimes of unfavorable development. But what that tells you when you see them start to correct it is that they are aware of what's happening and usually are pricing in to account for the fact that something might have happened, a couple of years ago with Geico, specifically with auto insurance. Smartphone came about. People were getting to more accidents, so frequencies were going up, and Geico will eventually have to price to account for those things, but it may show up. It may show up as unfavorable loss development for a time until they have corrected it. So again, for 2018, that developed favorably. And of course, we don't know what will happen with policy year 2019, but there's a significant amount of unknowns baked into this number. And also, here we can see the cumulative paid losses. So paid versus incurred. So taking accident year 2015, we can say they thought they would lose, call it 11 billion. What was actually paid took roughly 5 years to materialize. So ultimately, the difference between this ultimate liability of 10.9 billion and what was actually paid out took 5 years to ramp up. So even though Berkshire's balance sheet was saddled with this liability, the fact that the money had not gone out the door for 5 years is what generates that float. So as we go from physical damage, which is pretty easy to account, to some of this other stuff where, if you get into an accident and 3 years later you find out you need an organ transplant or something, and that is determined to be because of your accident, and they go back to the insurer and the insurer must pay, that is reflected in those longer tails, which again is still pretty short considering which is to be expected for auto. So at the end of 2019, they still had unpaid losses net. They incurred 69 billion, and they've yet to pay this 18 billion. And this does note that it's unaudited supplemental income information that they're provided to shareholders and other users of the financial statements. So when we go we go from Geico to the medical professional liability insurance. This is where you can really see the longer tails starting to play out, and you can see the loss development over time for, say, accident year 2010. And if you just jump from 2010, they thought that they would pay out 1.4. And by the time 2019 rolled around, 10 years later, that liability was ultimately estimated at 991 million. But really what you see here is both a pattern. You see this pattern of conservative underwriting. So these numbers over 10 years, you have a pretty good sense for what will happen. Those unknowns become knowns. and in Berkshire's case, it does move favorably. And the real excitement is in the paid losses of these type of insurance, and there's some percentages later that will really demonstrate this. But for something that in accident year 2010 thought they would ultimately pay out 1.4 billion, that first year they only 15 million went out the door, and by 2011 less than 100 million. So there is a long time for these to be paid. So as long as you're appropriately pricing your risk and your liabilities are what you think they will be, or better in this case, the longer that this stretches out, the longer the float stays with the company, and the more valuable it becomes. So this 12,530, you can take that, subtract so the incurred minus the paid equals the net unpaid. And then, of course, this is just 2010 to 2019. So everything before 2010, which could literally stretch back decades, those, of course, have shrunk, but still remain at 371. So you add those two. And for this category is a net of about 7.5 billion. Won't go through all these tables the same way, but the workers' comp, casualty, same thing. Look for those development patterns, and you also get a sense for how the payouts are structured. Property insurance, same thing here. Casualty, in this case, we can see some of the variability that occurs over time. So just taking accident year 2014, it was originally 1863, went up to 2058, back down slightly, down some more, down yet some more, and then back one up again. So these are estimates, and this proves that point. But it's interesting that they break them out by accident year, and actually the managers of the companies, they look at these in some cases in thousands of different ways. So this is broken out by accident year, but they classify these risks across a host of different categories. They call them loss cells, I guess, reserve cells, to basically take a cross-sectional view of how these losses occur by different categories, trying to look for patterns and insight that will tell them how to price these things. So unpaid loss and loss adjustment expenses, the average payout by age net of reinsurance. So go through this table, sort of really demonstrate the different types of insurance. So Geico, physical damage, again, first year, most of that's known. Tiny bit goes to the next year. Auto liability stretches out. Most of it's in the first year, and then it kind of peters out by year 5. But when you get into some of these others, again, they stretch out over a long period of time. But you look at something like the medical professional liability. Why is it only 2% the first year, and then it ramps up in year 3, 4, and 5, and then goes down? Well, usually a doctor, the type of insurance is such that a doctor might do something to a patient. Maybe a classic example is leaving a sponge in during a procedure. Well, that might not be discovered until year 3, 4, or 5. And even though it happened way back when, the doctor might have even changed insurers, but the insurance company at the time is the one that's liable for it. And so that's why they spike in starting in year 3, because these things take some time to become known. Some of the other ones have different loss development payout types of structures, but depending on the type of insurance, and you can usually figure out, or it usually makes intuitive sense when you think through what these things mean. And we'll move into the retroactive reinsurance contracts. Again, these, because they have this deferred charge asset, they are presented on a gross basis, and they also have loss development, but they are split between the deferred charges. The negative is because they're an asset, current year losses, as well as prior year losses, and you can really get a sense for the duration of the float of the retrocessional or retroactive reinsurance. So the 42 billion of unpaid losses over the last 3 years, there's about billion four, then another 900 million. Very little is actually paid out every year. So these liabilities grow, but the amount of capital that is retained for Berkshire's benefit grows as they continue to write these. And even if they don't continue to write them, the underwriting, because of this deferred charge amortization, which shows up in prior year, that's where this shows up. It shows up as a loss, but the actual amount being paid out is what matters from an economic standpoint. And this paragraph here is just saying that they don't report like these types of loss development listed above. They don't think there's any practical analytical value just because they're so far removed from the original source of the liability. Continue on here. This notes changes in laws, might affect the ultimate liability to Berkshire. And the biggest thing probably being the timing, because they do have caps on these policies. So other liabilities, notes payable, you can really get a sense for the strength of the Berkshire balance sheet. These Japanese yen denominated issue, 4 billion at 0.5%, just incredible. And walking through and into some of the other borrowings of the business, pretty favorable rates, and they do benefit from that Berkshire guarantee. But we do know that the railroad and utility business does not have that guarantee, so they pay a slightly higher rate, but they are still quite a favorable rate, all things considered. In each of these, and you can actually see the different covenants for both of these businesses, and even the specific covenants on some of the specific debt issuances. So most covenants, there's others, but leverage ratios, interest coverage, debt service coverage, even in the throes of the 2009 crash, Berkshire Hathaway or the railroad rather had interest coverage, I think over 6 times. Just very, very strong, even in times of trouble. They also have unused lines of credit, principal payments, and this is another important feature. Berkshire structures its debt such that these payments stretch out over time. So in addition to the insurance liabilities that have payments stretching out over time and cannot be called quickly, Berkshire structures its actual debt so that it can't be called upon for large amounts of cash at any time. Income taxes. So the net on the balance sheet would be these two figures for 18 and 19. We saw those on the consolidated balance sheet. And the deferred amounts are listed here. We'll get into that in just a second. The components of that net. So the 65,823 up here, we see that same number down here, and that is a the result of the deferred tax liabilities as well as deferred tax assets. So the net of those two equal to $66 billion. Now Berkshire has, because it defers, because of accelerated depreciation as well as deferred tax on its investments, the actual tax that's reflected in the income statement does not actually reflect the amount that's paid. So of the $20 billion in tax that's on that income statement, just $5.8 billion is currently due. And the $15 billion that's deferred, which is the net between these two figures, is ultimately payable, just like the insurance float, but is not currently due. And so that amount will not be leaving the Berkshire balance sheet anytime, at least within the next year. So here, this income tax, they start with what the pre-tax income, and again, this includes the unrealized gains. But here's what Berkshire would pay. Here's its earnings before taxes. Here's a hypothetical tax of what it would pay at that 21% rate. And then it goes through and walks through what that actual figure is listed on the income statement. And because of that double taxation, the rate on dividends is lower, and so that lowers the tax liability. There's also state income taxes, some foreign differences, income tax credits, primarily from the energy business, but there's also some others that Berkshire has participated in the past. That gets you to that 2904 that we see here. And again, only $5.8 billion is currently due, and $15 billion is added to the balance sheet that will be paid in future years. So some information on the insurance subsidiaries. They can pass along $21 billion to Berkshire at any time. Any more, they'd have to get the insurance regulatory authorities to approve it. But because they have such a strong balance sheet, $216 billion of equity, they do have significant flexibility. This table here, fair value measurements, it walks through some of the values in the balance sheet and alerts the reader to which values are more firm than others. So quoted prices, as we would expect, most of the equity investments, those are on an exchange. You can look them up. Those are pretty easily knowable. So they're this level 1. Level 2, there's certain other inputs that go into these. And level 3, there's fewer assets in this category, but they are determined based on significant inputs that Berkshire makes. And you can see that sort of an idea of what the different levels entail in terms of management discretion. And this is just a reconciliation of the level 3 assets through time. I won't go through this table. You know, something like I'll just pause here for a minute, something like Lehman Brothers or a business that has a large amount of level 3 or things that are going between years or between categories, it may be worth paying attention to because there can be some funny business going on within those categories. But, you know, we can see here that these level 3, some are in equity securities, some are loans and finance receivables, which again, were probably primarily Clayton, as well as some other receivables that they have. So we have a pretty good sense that the assets that are reflected and the liabilities that are reflected are the true value. So you can see here the different types of assumptions. So preferred stock, so that's the Occidental. This year, They use a discounted cash flow method, expected duration over 10 years. And same thing with warrants. The derivatives, even though Buffett does not like the Black-Scholes model, he says, we basically just have to use it. It's what the market uses. But when contracts stretch over a few years, up to 10 years, things really do get kind of crazy in terms of their output of values. Common stock, here's, again, starting 2016, walks through to the present year. Conversions of Class A to Class B affect the number of shares within each category. And then the shares acquired through treasury stock transactions are listed here. And here's where you want to pick up the number of shares outstanding at year end. So Berkshire transforms them into a Class A equivalent basis. And that's the number you primarily want to work with. You can convert them to Class B by using that 1/1500th. This table, not too much really to see here. Different changes in other comprehensive, accumulated other comprehensive income, how they flow through over time in terms of the unrealized appreciation of investments, which is the biggest in that category, foreign translation, defined benefit plans, just how they flow through between each category and each year to get to that bottom line every year. So as we saw above, Berkshire paid or incurred rather $20 billion of tax. That's what it said was its liability. Only would have current taxes due of that $5 billion. And here we can see the actual cash paid for taxes, which for the level of income that they had over that time is quite modest. And that's something unique feature of Berkshire that is not very well understood, that they can defer a significant amount of tax over time, and even though it shows up as an accumulated liability, that is money that is sitting around that works towards Berkshire's benefit and Berkshire's shareholders' benefit. It will ultimately get paid out, but Buffett is a master of finding ways to defer tax, pay as little as possible, and will ultimately pay more to the Treasury because it's doing this. But it's just deferred to the future. We'll continue on with the audited financial statements here with revenues from contracts with customers. So this breaks down all of the revenues that Berkshire has across these categories and across each company. Kind of interesting to see, not really too much analytical value here. They do note that the insurance is included in this other category. And again, to tie out the number, this 254,616 is Berkshire's revenues for 2019. Pension plans, very important piece of analysis here. So this table here just walks through the expense that's recorded. So there's a service cost, interest cost. The expected return is a negative because you're expected to gain some income from the portfolio, which offsets some of these costs for a net negative of 68 million. So we can see here at the end of the year, Berkshire had an obligation of 18.7 billion, had assets to fund that of 16 billion, and had a net liability of 2.2 billion. And this statement here tells us where those assets, the net asset and liability, is included in the balance sheet. This is probably the single, in addition to, it affects this net liability, but this expected return on assets is something that should garner more attention, certainly from analysts, but from others. Berkshire's saying that it expects to earn 6.4% going forward. So the higher that return is, the lower the net liability is here. And because what it does is it lowers the ultimate liability, at least on paper. Now the actual is going to be the actual over time, but these key inputs here, one of the most important is this expected return on plan assets, and companies can make their financial statements look better by having a higher expected return, and that will get them in trouble over time. So we can see the benefit payments that are expected over the next few years, and here we can see what that portfolio looks like. So Buffett has said in the past, in relation to the Washington Post, that he wrote this letter to K. Graham saying that companies have this essentially another division within their business that they often forget about, which is their benefit plan. And this, in Berkshire's case, nothing to sneeze at. $16 billion of assets that are working on Berkshire's behalf that ultimately have to cover that pension liability. And we can see Buffett puts his money where his mouth is, and is investing this portfolio primarily in equity securities. And some of those are actually managed by Todd and Ted. 401k plans, not a surprise, lists what that expense was here. Commitments, again, some of those other future payments for contracts, leases, debt, so forth. Business segment data, this is just another way of looking at it. This table used to be actually at the beginning. I usually found this pretty useful, especially some of the pre-tax figures. As you walk through here, this interest expense not allocated to segments, so that's some of the parent company amounts, and this 254,616 again. That's that revenue figure from the income statement. We've seen these numbers here before. Again, the capital expenditures, 16 billion, depreciation of 8.7. So they've spent significantly more on depreciation than their or on capital expenditures than their depreciation. We get a sense for how the goodwill is allocated over units, and this 15 billion, hasn't changed very much over time, and a good amount of that, I believe, is attributable to the General Re acquisition in 2000 or 1998, rather. And then this reconciles the identifiable assets, this 81,882 of goodwill. See that again here. And that flows through to the total of Berkshire Hathaway's assets. Insurance premiums by geographic region. Kind of interesting to note, most of it's written in the United States for property casualty. Same with life health, although the life health does have a pretty meaningful distribution around the world. Continue here. Again, broken out by geographic region. 85% of revenues were in the United States. 96% of revenues from the railroad and energy business were in the United States. That's not surprising. 89% of property, plant, and equipment was in the United States, with most of it in the remainder in Canada and Europe. Quarterly data, I don't really pay too much attention to this. Buffett doesn't either. Things happen during the quarter. Really not a huge amount of information, analytical value here, especially when especially as it relates to these investment and derivatives gains and losses. Continue on through some of these final parts here. Some of the financial schedules. This is a parent company level balance sheet. So it's just that same balance sheet basically condensed into what resides at the parent company level. Kraft Heinz is actually held here. So the equity investment in the subsidiaries is listed here, which is the bulk of the assets. And then the parent company borrowings are right here. Corporate level interest expense. I believe could be wrong on this, but the 400 some odd million listed on the segment data differs from this listed here. I believe that might be the net between these two. Okay, I'm not entirely sure why this net differs from the segment data, although Berkshire does charge Clayton Homes as well as the tank car business a fee for Berkshire guaranteeing its liabilities. So they get a lower cost of funding because Berkshire guarantees it. And so there's a fee that's paid to the parent company from, or at least to Berkshire Hathaway Finance Company, I think. I don't know how it's exactly structured now, but that may account for the difference. But in any event, the interest expense associated with this debt shows up here, and then everything else is included within the undistributed earnings from the subsidiaries. We can see the cash flow, acquisition of treasury stock flows up here. Income taxes paid. And then again, this debt is structured such that, so of the 20 billion, only a little over $1.1 billion comes due in 2020, $2 billion the next year. So it's structured to go out over time. These exhibits, if you actually go to the SEC website, you can find these original filings. They're incorporated by reference here, but you can actually go, for example, to 1998 or 2003. This indenture is filed along with the 10K, and you can, it's many hundreds of pages in some cases, but you can read you can find out the covenants that are in there. You can find out all kinds of interesting things in those exhibits. Almost done the report here. So there's signatures, the certifications that the chief financial officer makes, and then the whole board of directors signs the report. Operating. Here's just some supplemental information, and thought this was interesting to point out. Of all the huge dollar amounts, policies that are written by the reinsurance group, there's just 558 employees compared to 50,000 across all of the other operating companies. Again, just interesting to kind of peruse and see both the names of all these businesses, how many they employ, and especially when you look and see that just 26 reside at Berkshire headquarters. And Marmon, they do note, is made up of 100 more companies. So, when you think of the whole of Berkshire Hathaway, there are many, well over 100 separate businesses within it. This is a supplemental piece of information for shareholders. The meeting, which would have happened this past weekend. Very, very fun event. Sad I missed it. Would have been my 9th year in a row. You can write to these journalists to see if you can have your question answered or asked rather. No guarantee that it will be answered. These are some of the events that happen. Worth checking out. If you are interested in going to the meeting, I'd be happy to help you with that. I've made, or started to make, a video of how to go through what to do, how to get there, tips for travel, that sort of thing. If you're interested, please let me know. And some information on the transfer agent. And that's just about the Berkshire Annual Report officers and directors listed here. We did find out this past year Bill Gates is stepping down, both from the Berkshire board as well as the Microsoft board, to pursue philanthropy full time. A lot of these, I should do a report on the proxy statement, but the age of this board, average age is probably in the 70s. David Gottesman is in his 90s, as well as Tom Murphy. But this is a star-studded board of directors. So that is the end of 144 pages of the Berkshire Hathaway Annual Report 10K. If you liked it, please subscribe. If you didn't, let me know why. If you made it this far, I hope you did like it. Please let me know how I can improve, what else you'd like to see, and anything else that's on your mind. So thanks for watching, and hope you tune in soon.